Basically, these are AI software companies. Phase 4 is all about physical AI, like autonomous driving and robotics. But I think we are at least 3 to 5 years away from mass adoptions. So investors should have plenty of time to slowly gain exposure to robotics or autonomous driving related companies itself. So all in all, the biggest innovation narrative this year is still agentic AI software itself. So one of the better ways to gain exposure to AI software companies is by investing in the Magnificent Seven stocks because all of them have some level of AI software capability. However, their main revenue sources are not from AI software. For example, Tesla still makes more money selling cars than selling its FSD software, full self-driving software. Or as Amazon CEO Andy Jassy mentioned, AI is generating multi-billion dollar revenue for Amazon, but you just do not know exactly how much it is. So all Magnificent Seven companies do not disclose the exact amount of AI revenue. Uh, the majority of their revenue still comes from other core businesses. So as a result, most investors do not really view them as pure AI software companies. So if investors want to invest in an AI software company, they probably prefer a purer AI software play. So one that derives most of the revenue from selling AI software solutions. Examples include Synosys, Candace, CrowdStrike, Palo Alto Network, Salesforce, C3 AI, Snowflake, ServiceNow, and Palantir. Keep in mind that AI software companies are generally not heavily impacted by tariffs because tariffs tend to focus on physical goods, products, rather than digital services. The only major software related restrictions that I can recall is the export control, is the export restriction on EDA software to China, which impacts companies like Synosys and Candace. Having said that, both Synosys and Candace derive less than 12% of their revenue from China. So the overall impact is relatively limited. Most AI software companies do not break down their revenue exposure by country. Instead, they typically report it as a broader Asia Pac figure. For example, if we were to look at Salesforce, Salesforce reports 11% of its revenue from Asia. So we can reasonably assume that the China exposure is less than 11%. But the exact figure remains unknown. For Palantir, I have shown China exposure as not available since the company does not disclose it, but some research houses suggest that Palantir has no exposure to China at all. Okay, and there are many smaller cap AI software companies out there, and the share price movement is quite exciting. But I think it's better for retail investors to focus on the bigger names. My personal preference is to focus on companies with market caps above 200 billion, such as Salesforce, ServiceNow, and Palantir. The main reason is that larger cap companies tend to be less volatile, and by the time they reach this kind of market cap size, like above $200 billion market cap, the market has often recognized them as leaders in their specific AI software field itself. Okay, let's go through some of these companies one by one, starting with Candace and Synosys. So Candace and Synosys are the leading providers of EDA software, electronic design automation. So they help chip makers like Nvidia and Broadcom design, verify, and optimize semiconductor chips. To put it simply, chips maker use Candace or Synosys EDA tools to ensure that their AI chips work perfectly, correctly. And Candace holds about 30% market share in the EDA space, while Synosys has around 31%. They are both market leaders, and their stock prices often move in line. I like them both, but they probably don't have the best outlook among the AI software companies because both companies have relatively smaller total addressable market. The total addressable market is estimated to reach 32 billion by 2032, up from about 17 billion in 2025 itself. Okay, and that's not a lot. And one thing I don't like about them is that the revenue growth in 2025 is quite unexciting at 11% as well. Okay, now let's talk about CrowdStrike. It's a cybersecurity company. CrowdStrike recently said that the AI native security platform has a total addressable market of 116 billion this year, estimated to double to about 250 billion by 2029. However, I sometimes feel that CrowdStrike is underappreciated by a lot of investors, and it will stay underappreciated. It may take a major cyber attack for investors to fully recognize the technological edge of CrowdStrike's cybersecurity platform itself. Or let me put it another way. CrowdStrike platform does not directly improve does not directly improve business productivity. It's more about prevention. Companies spend on cybersecurity to avoid costly disaster. In contrast, investors may prefer AI software companies that directly enhance efficiency, productivity, or profitability. Okay, let's talk about Salesforce. Salesforce is CRM company, customer relationship management company. It has the largest share in the CRM market at around 21%. Microsoft being the second largest at only 5% market share. So this suggests to me that CRM market is highly fragmented. Okay, having said that, I don't really consider a 20% market share as market leader for Salesforce. For comparison, NVIDIA holds about 90% of the GPU market. So 20% for Salesforce feels like it's quite insignificant in contrast. This is why I think that Salesforce does not really have good pricing power. Another important thing to know about Salesforce is the total addressable market. Recently, the Salesforce CEO, Mark Benioff, said that the total addressable market is 1 trillion by 2030, up from 245 billion today. And I think that he's probably too optimistic. Because if the revenue of Salesforce is currently growing at around just 9% this year, it is probably won't grow that big by 2030. Okay. And I will spend more time on ServiceNow and Palantir. Okay, the main reason I want to highlight ServiceNow and Palantir is because they have been two of the best performing AI software companies over the past 1 year. Palantir returned 570%, ServiceNow returned 145% over the past 1 year. Okay, let's start with Palantir before moving on to ServiceNow. Okay, Palantir is a popular AI software company. Last year, Palantir stock returned 340%, and 2025 year to date, it is up by 70 something percent. So what is particularly interesting about Palantir is that analysts consistently underestimate the potential. Oftentimes, the share price in white line runs ahead of the consensus analyst target price in blue line. But it's completely natural for analysts to assign a target price that is lower than the current share price itself, especially when the Palantir stock has run ahead of the fundamentals. What do I mean by that? If you were to look at the PE ratio of Palantir, it's trading at 560 times and a forward PE ratio of 213 times itself. So this suggests to us that the current share price has already priced in a significant portion of the future earnings growth, or that investors are expecting even more aggressive growth to justify today's valuations. Okay, one of the reasons investors have such a high expectation for Palantir is because of the narrative around it. So most investors assume that Palantir has a superior AI platform compared to the peers. Let's talk about Palantir product offering. The most important thing to know about Palantir is that Palantir provides a suite of powerful, advanced analytics platforms that help organizations analyze complex data and make better decisions using the data. The first Palantir products is Gotham. Gotham launched in 2008. It is designed mainly for government and defense agencies. Some of the notable customers include CIA, FBI, NSA, and Department of Defense. Okay, these agencies use Palantir platform Gotham for counter-terrorism, cyber operations, and defense logistics. Rumor has it that Palantir Gotham platform helped convict uh, Ponzi schemer Bernie Madoff, and Gotham was also used to track down terrorists. So based on these reputations, many investors then assume that Palantir has a superior AI platform compared to its peers. For businesses, Palantir has Foundry, which helps companies streamline their operations. So Palantir Foundry was launched in 2016 itself. So Foundry is like Gotham, but designed for commercial use, business use. Palantir Foundry is like a smart control center that helps big companies pull all their messy data into one place and turns into actionable insights. So the company can work faster and smarter. For example, Airbus uses Foundry to track millions of parts and processes when building the A350 plane, helping them spot delays, fix problems quicker, and deliver planes faster. And now let's talk about Apollo. Uh, Apollo is the engine behind the scenes. It's what keeps Palantir platform like Foundry and Gotham running smoothly, securely, and continuously no matter where they are deployed. So basically, what makes Apollo special is that it allows software updates to happen automatically. even in the most sensitive or disconnected environments like military bases, submarines, or classified networks there, where traditional software as a service cannot go. Okay, bear in mind that Apollo is not marketed as a standalone platform. You usually buy Gotham together with Apollo or Foundry together with Apollo. Okay, lastly, Palantir's latest product is AIP, AI platform. AIP is not an analytical tool by itself, but rather a platform that allows users to interact with LLM, large language models like ChatGPT and Anthropic, and use them to perform tasks like asking for data, summarizing reports, or automating tasks or simulate outcomes. However, AIP still needs an underlying analytical or platform or data platform to perform, uh, to work with. So this could be Foundry, or it could be a third-party platform like Snowflake, Databricks, or a proprietary system itself. Yeah. Okay, to put it simply, Foundry does most of the heavy lifting with data. So Foundry is like a super smart spreadsheet system that collects, organizes, and analyzes company data. It helps us to see patterns and make decisions. AIP sits on top of Foundry and makes it easier for anyone to interact with that data and take action using natural language or just a simple prompts itself. Okay, let's talk about Palantir customer breakdown. There are a few key takeaways here. Firstly, commercial customers account for about 45% of the total revenue, while government makes up the remaining 55%. The revenue mix is expected to remain largely unchanged over the next 2 years. So this basically means that Palantir still relies heavily on government revenue. Secondly, government alone accounts for about 76% of the total government revenue across the world. And due to national security concerns and data sensitivity, many foreign governments may be hesitant to adopt software developed by a US-based company with deep ties with American intelligence and defense agency itself. So personally, I do not expect significant growth in international government revenue. This also means that Palantir faces client concentration risk, particularly with the US government. Thirdly, analysts do not expect much growth in the international revenue from the commercial segment either. The US accounts for about 54% of the total commercial revenue in 2024 and is projected to grow to about 66% in 2025 and 73% in 2026. And I believe that European companies have been slower to adopt AI-related services compared to the US, which likely explains the slow international growth for commercial segment itself. So one positive is that if Palantir continue to focus on their US market, it won't be heavily impacted by the tariff. Additionally, government spending cuts like Dodge could actually encourage agency to adopt Palantir platform more, as it is meant to improve efficiency and reduce the manual labor. In other words, governments may be able to lay off workers while improving productivities thanks to the Palantir AI software itself. Okay, one thing I like about Palantir is that there is always news about the company securing new commercial or government contracts. The table here illustrates Palantir's strong ability to win high value, high profile deals. You can see that the number of contracts above 10 million has increased year on year. Additionally, the number of contracts in the 5 million to 10 million range is growing faster than those in the 1 to 5 million range itself. So indicating good momentum in larger deal sizes. And I also look at other things to measure the quality of the customer. I look at NDR. So NDR is net dollar retentions. It measures how much existing customers are spending over time, which you can see is 124% now. So why can it be more than 100%? Because your existing customers are spending more with you this year than last year. For example, a customer paid Palantir 1 million last year, and the same customer pays 1.24 million this year. This is why you see 124%. And we could also see the remaining performance obligations are increasing as well, quarter by quarter. These are the total value of contracts Palantir has signed but has not delivered yet. Okay, now let's look at quarterly revenue, operating income, and profit margin. Firstly, revenue growth in the latest quarter is 39% year on year, with forecasts of 38% and 35% for the next 2 quarters. Not many AI companies are still growing at over 30%. So this is quite impressive. Secondly, operating income grew 117% in the latest quarter, with 63% and 57% growth expected in the following 2 quarters. That sounds impressive, but in reality, operating income was 176 million in the latest quarter, and analysts expect it to be 172 million the next quarter and 178 million in the next quarter itself. So on a quarter-on-quarter basis, the growth is not doing much. So it's relatively flat. This is likely due to stock-based compensation, so which result in high non-cash expenses. That also explains why operating margin that you can see here are expected to remain 18%, remain at 18% over the next 2 quarters as well. Not particularly exciting from a profitability standpoint itself. Okay, the crucial question you should ask is, what is stock-based compensation? Stock-based compensation is when a company pays employees with company shares instead of cash. And this is important because Palantir still pays a significant amount in stock-based compensation. So under GAAP accounting rules, this stock-based compensation must be recorded as expenses in the income statement, which ultimately reduces the reported profit. This means when Palantir pays a lot of stock-based compensation to the employee, the operating income will be lower. For example, in Palantir cases, stock-based compensation was allocated to departments like marketing, admin, and research and development, which directly impacted the operating margin. So in 2024, based on GAAP accounting, Palantir GAAP operating margin was just 10%. Okay. And if you exclude stock-based compensation, the adjusted operating margin jumps to 39%. So there's a massive 30 percentage point difference, showing you how much stock-based compensation can distort the profitability metrics itself. So meaning to say, it is difficult for analysts to predict how much stock-based compensation Palantir will issue in the future. All we can do is hope that the company will reduce the stock-based compensation going forward. So the operating margin can improve on a GAAP accounting basis. But looking at Palantir stock-based compensation over the past few years, it was 1.2 billion in 2020 and has dropped to about 692 million in 2024. So it's likely that stock-based compensation has stabilized around this level. So if stock-based compensation stabilizes and Palantir revenue continue to grow, the operating margin should also gradually improve as well. So this is exactly what analysts are projecting. Operating margin is expected to rise to about 19 to 20% over the next 2 years, up from 10% in 2024, driven by strong top-line revenue growth itself. And the most exciting part about Palantir is that the performance under the Rule of 40. So Rule of 40 is a metric widely used by SaaS companies. So the Rule of 40 is a principle that states a software company revenue growth plus the profit margin should equal or above 40% to be considered financially healthy. So in the case of Palantir, it is now achieving Rule of 40 score of about 81%, about 81% in the latest quarter. In comparison, ServiceNow is 52%, CrowdStrike is 56%, Salesforce is 41%. So Palantir currently has one of the highest Rule of 40 score in the latest quarter among all the AI software companies. Okay, I want to talk about upside catalyst first. Okay, Palantir has managed to secure high-profile government projects, and his close ties with Trump administration could potentially help the company win more government contracts going forward. And we have also been seeing faster adoption in Palantir AIP and other AI-driven platform as well. And let's look at downside catalysts. US government deals are strong, but they may come at an expenses of the commercial growth itself. If we were to look at commercial growth, the commercial expansion outside the US is already slowing down, partly due to a decline in the international customers. So there is concern that Palantir deep involvement in the US government may make non-US or commercial clients hesitant due to data privacy itself. And another risk is client concentration risk. Palantir remains heavily reliant on US government spending. On top of that, CEO Alex Karp has also announced plans to sell 10 million shares, which could potentially weigh on investor sentiment in the short term. But perhaps the biggest risk is still valuations. Palantir is trading at a high PE ratio of around 560 times. Having said that, we have also seen similar stories before. Both Amazon and Tesla traded at extremely high valuations in their early growth stage, yet their share prices continue to rise before any major corrections. So I do not believe that high valuation alone means that the stock is going to crash tomorrow. It just means that Palantir needs to continue delivering strong results and consistently surprising investors to keep the shares price elevated itself. Okay, I want to quickly go through the technical analysis for Palantir. Uh, the stock is still in an uptrend. Okay, I'm using Fibonacci retracement to identify the potential support and resistance level. To do this, I drew a retracement from the 2023 low to the 2024 high, which reveals some of the key Fibonacci levels. And next, I am also using Fibonacci expansion to project the potential upside targets as well. What I did is I just replicate the previous uptrend here and assume that the uptrend will continue the same movement from the recent low here itself. So I put the Fibonacci retracement expansion level together, then you can see some overlapping levels itself. So this is called the Fibonacci conference zone. So basically what it means that these are some of the crucial supports and resistance level like 147, 118, 106 itself. And here also show you some other major resistance level and support levels based on Fibonacci analysis, 130, 90, 84, and 67. So these are some of the prices you may consider to focus on when you do tradings or investment. Okay, the current Bloomberg analyst consensus 12-month target price for Palantir is 104, which represent a downside potential of 21% from the current share price of $132. Okay, so the Bloomberg consensus is it may drop by about 21% from the yesterday closing price. In conclusion, I like almost everything about Palantir except for the high valuations and the elevated share price itself. It seems like investors have already decided that Palantir is one of the best ways to gain exposure to agentic AI. So Palantir has consistently surprised on the upside with the earnings result and forward guidance. I think that as long as the company continue to deliver earnings surprises, the share price may continue to stay high or go even higher, even with the premium valuation itself. So you need to focus on the revenue growth and operating income growth itself. I remain constructive on Palantir long-term outlook, but you shouldn't be surprised that if it dropped by 40% or 50% before staging a bull run itself. I think investors should carefully managing your position sizing. Okay. So high valuation is a concern, but I remain constructive on the long term. Okay, you can also join our Cash Boost account, Telegram community to learn more about Cash Boost account and receive constant market update. We will talk about the latest market news and event that move the market. So please scan this and join us on Telegram. Okay. Okay, now let's talk about ServiceNow. Okay, first thing first, what is ServiceNow? ServiceNow is widely recognized as the world's leading end-to-end workflow automation platform. It's cloud-based, AI-driven software that helps organizations streamline, automate workflows across IT, HR, and customer service. You can think of it as an AI software platform that automates repetitive tasks, improves efficiency, and keeps your IT system running smoothly itself. If you look at the revenue breakdown, 97% of the ServiceNow revenue comes from subscription service, Under the subscription service, there are two major components, ITOM and digital workflow production. ITOM accounts for about 11% of the total revenue, while digital workflow products makes up 86%. Much of the ServiceNow revenue comes from ITSM, and it is the main source of the subscription revenue. Basically, ITSM is IT service management, is an IT help desk business. For example, if you forget your computer password, you lodge a ticket on the ServiceNow platform, and it will assign the request to the right IT personnel who then receive it and help you reset the password. To put it simply, ITSM looks like a clever work task allocation system itself, but it also goes beyond that. It helps you categorize, prioritize IT issues, automate approval workflows, and it also suggests solution as well. I reckon investors like ServiceNow because it's easy to understand. If I were to guess, I think many companies are willing to spend on ITSM because they can immediately see improvement in the workflow efficiency and easily justify the investment. So they might say that because of ITSM, workflow efficiency improved by a measurable percentage. What is important is ServiceNow platform could also provide AI suggestion. For example, ServiceNow is able to provide AI recommended solution based on past case studies. So before the IT personnel receive the ticket, a potential resolution is already suggested. And the IT personnel can just react based on the resolutions suggested by ServiceNow AI, and hence this will improve the productivity. Okay, ServiceNow has large customer base. More than 80% of the Fortune 500 companies already use ServiceNow. ServiceNow is the market leader in ITSM and owns about 39% of the market share. BMC is in the second place with 12% market share. Microsoft is in the third place with 6% market share. A few things to look at to determine whether ServiceNow is growing its business. The first metric I look at is ROP, remaining performance obligations. So again, ROP represent the total value of future services that ServiceNow is contractually committed to deliver and has not yet delivered. So in the latest quarter, RPO grew by approximately 24% year on year in 2024, and is projected to grow by 21% in 2025 and 20% in 2026 itself. The second metric is ACV. ACV is annual contract value. We can see that the number of customers with an ACV above 5 million is still growing. There are now 508 such customers in Q1 2025 compared to 425 in the same period 1 year ago. The average contract value is also increasing to 14.2 million in the latest quarter. It was 13 million 1 year earlier. The third metric I look at is renewal rate. This represents the percentage of customers who renew their subscriptions when their contracts expire. So ServiceNow renewal rate consistently remains high at 98%, indicating strong customer stickiness and satisfactions. This is the revenue breakdown by geography. So the US accounts for about 64% of total revenue. This means that if tariff were imposed on ServiceNow product, they would impact at most 36% of the revenue. APAC, including China, accounts for 11% of the total revenue. So suffice to say that ServiceNow has limited exposure to China. Okay, here show you the revenue, operating income, year-on-year growth, and gross margin, operating margin. Some key takeaway here. Firstly, the year-on-year revenue growth has been slowing down to about 18% in Q1 2025 from 26% in Q1 2022. Okay, secondly, the operating income year-on-year growth is also came down to 36% in the latest quarter from 130% in Q1 2024 itself. Okay, currently analysts project revenue to grow at 19% in 2025, 19% in 2026, and 19% in 2027. So all in all, the revenue growth and operating income growth is unexciting. I also want to touch on stock-based compensations. ServiceNow faces similar stock-based compensation issue like Palantir. So stock-based compensation again reduces the reported operating profit margin under GAAP accounting. However, unlike Palantir, ServiceNow has provided clear guidance on stock-based compensations. Basically, ServiceNow say that it aims to reduce stock-based compensation as a percentage of revenue to below 15% by 2026 and below 10% over the long run. In 2024, ServiceNow GAAP operating margin was about 12%, but the adjusted operating margin, excluding stock-based compensation, was significantly higher at 29%. The company has also provided a guidance that the adjusted operating margin will rise to 30.5% in 2025, with an increase of 1 percentage point in 2026 and another 1 percentage point increase in 2027. So to put it into perspective, ServiceNow has historically expanded its operating margin by probably 1 percentage point each year. So increasing by 5% percentage point from 24% in 2020 to about 29% in 2024 itself. So this reflects that it constantly improves steadily, but it may feel underwhelming for a growth company. Personally, I would probably prefer to see operating margin exceeded 40% and stabilize around 40%. In comparison, Palantir is already operating at a higher operating margin. Analysts expect Palantir operating margin to remain flat at probably 44% in both 2025 and 2026, which is quite good because it reflects sustained profitability at a high level for Palantir. In other words, I reckon growth investor will prefer Palantir. ServiceNow, on the other hand, currently has a PE ratio of 136 times, and it may eventually be considered as a value stocks if the valuations decline significantly over time from 136 times itself. I reckon ServiceNow isn't trying hard to increase the profit margin by a lot each year because it just want to maintain a certain profit margin to capture more market share. It is probably trying to focus on growing the revenue and trying to grow the actual dollar profit, meaning it tries to increase the operating income, operating margin itself. Sorry, operating profit, operating income itself. To put it simply, even though the profit margin stays about the same at 30%, the company may make more money overall because the revenue goes up. Okay, what I like about ServiceNow is that it achieved around 50% on the rule of 40. But if you study the number, you could see that the rule of 40 performance for ServiceNow has stagnant around 50% for a couple of years now. So in contrast, Palantir rule of 40 continue to improve. It is now approaching 80% in the latest quarter. Yeah. So now I want to spend some time comparing Palantir and ServiceNow and try to answer one crucial question. Why is Palantir market cap significantly higher the than ServiceNow? So we could see that Palantir currently has a market cap of 301 billion, while ServiceNow is at 213 billion, about 90 billion lesser. But when you look at their revenue and operating income, the difference doesn't seem to make much sense. So ServiceNow revenue is about 11 billion. Palantir is just 2.8 billion, meaning ServiceNow generates nearly 4 times more revenue than Palantir. In terms of operating income, ServiceNow reports 1.3 billion, while Palantir earn about 310 million, roughly 1/3 of ServiceNow figure. So this suggests that ServiceNow has either a larger current total addressable market, or at least has captured a bigger share of the total addressable market compared to Palantir. Okay. However, I reckon the reason Palantir has a higher market cap, a larger market cap, is because investors are betting on his long-term growth potential. So Palantir current total addressable market is 19 billion, but analysts project it to grow to 1.4 trillion by 2033. In contrast, ServiceNow total addressable market was just 165 billion in 2023, but analysts project it could grow to 350 billion by 2027. So an analyst forecasts ServiceNow revenue to grow at 19% year on year, while Palantir revenue is expected to grow at 36% year on year. So all in all, the divergence in market cap suggests that the market is pricing in significantly more future growth potential for Palantir than for ServiceNow. Okay, let's briefly go through the upside and downside catalyst for ServiceNow. So on the upside, ongoing digital transformation and growing demand for workflow automations continue to benefit ServiceNow. The company is also expanding the total addressable market by entering into the CRM market. Okay, revenue is growing at 20% year on year, which remains one of the highest growth rates among software companies. On the downside, valuation is also a concern. ServiceNow trades at a PE ratio of 136 times, making it one of the most expensive AI software companies. In addition, the revenue growth forecast and profit margin expansion may not be particularly compelling for a growth investor. It is also worth noting that ServiceNow generates estimated 11% of the total revenue from the public sector, so one of the highest among the large software companies. So if public sectors cut spending like Dodge, it could negatively impact ServiceNow performance. Okay, here I also use Fibonacci expansion to find out the major support and resistance level. You could see that some of the nice price reactions towards 128 and 683 and probably 1049 as well. So basically the immediate resistance is 1049. The current share price is 1026. Once broken above the 1049 level, you should be looking at 1128, 1243, 1337 as the next resistance levels for ServiceNow. So the current Bloomberg analyst consensus 12-month target price for ServiceNow is $1084, representing an upside potential of 5.6% from yesterday's closing price of 1026. In conclusion, I reckon ServiceNow is one of the better AI software companies, but still not as promising as Palantir in terms of the future growth prospects. ServiceNow is likely to remain the market leader in the ITSM solutions because I believe competitors like Microsoft lag behind in advanced workflow, scalability, and AI capabilities. Alternatively, competitors like Microsoft may simply lack the motivations to incur CapEx to pursue market share in the ITSM space. Maybe because Microsoft reckoned that the total addressable market for ITSM is relatively small, so Microsoft want to focus on other things, maybe. All in all, I think the revenue growth of 20% year on year going forward is decent, nothing too exciting. But ServiceNow is still offering higher growth than some other AI software companies. I am constructive on ServiceNow, but I probably would say that Palantir may outperform ServiceNow in longer term due to larger total addressable market itself. Okay, I come to the final few slides. I just want to show you an update of the aggressive portfolios that I showed everyone in the beginning of the year. So the year-to-date return for this aggressive portfolio is 2.7%. The performance is quite similar to the S&P 500 at 2.7% as well, but underperforming the Nasdaq 100 4.1% return. So some of the features of this aggressive portfolio are Max 7 accounts for 60% of the total portfolio weight, and AI-related stocks account for 80% of the portfolio weight. So if AI stocks plunge this year, portfolio will perform badly itself. And this portfolio, again, you can see that heavily focused on Max 7, and Max 7 doesn't really outperform this year. So this has dragged down the overall performance as well. Okay, the white line here represents the aggressive portfolio, and the maximum drawdown uh, for this portfolio was about 26%. Okay, overall, this aggressive portfolio is a high-risk portfolio. Some of the stocks here have a higher standard deviation and maximum drawdown, uh, easily double that of the S&P 500 itself. So before taking a page from this portfolio, please do your own research to better understand the companies in this portfolio and make sure you understand your own uh, risk profile as well. Okay, so before I end, please join our Cash Boost account Telegram group to learn more about Cash Boost account.